What up, traders? So I'm going to show you the right way to use volume, my way. I like to think it's the right way, and you hear it all the time. Volume confirms the move. If volume's there, not there, it's a trap, it's not a trap. But what does that actually mean? What does it look like on a chart? And why do so many traders just get wrecked over and over and over again following this cliche? Take a look at this S&P 500 futures play right here, ES1 ticker. Start pumping up, breakout, boom, boom. Everyone piles in. All the breakout traders pile in here, bringing price up right into what? Absorption into sellers, and the price nukes. Versus here, same ticker, boom, boom, and it dumps. No fake out, it just goes. Now let's look at volume. Let's look at raw volume. On the fake out where we pumped up, trapped those traders, breakout traders long, pile in, and then it nukes. Volume confirmed the move. It was there, plenty of volume. How about this breakdown that we looked at? Volume confirmed the move. So we have two confirmed volume moves, heavy volume. One went, the other didn't. Let's bust this first myth right away. Volume spikes every single day during that London to New York overlap. Raw volume does not equal confirmation. Context matters. Without a little bit more context, like session and structure and who's in control, volume confirms is flawed logic. And the asset doesn't matter, and I'll show you. I mean, here is the euro to the dollar. We can see a break up, a second attempt, and then it falters, right? Look at volume. Look at OBV. You can see the warning signs here. There was actually a little divergence from this side to this side, boom to boom, and volume just did not confirm. On top of that, you had momentum divergences, and then we can see from one high to the next, CBD also didn't confirm it. The sellers took over here. Here's Bitcoin. This is actually a short that I took today on Bitcoin. This was London session high. Bitcoin swept up. Volume was declining. We SFP'd it, and then I shorted it, and then boom. It was a nice play. This is $1 million plus orders. Let me just show you what retail did there. So let's switch this from 0 to 10K, the small guys, the guppies. Look what they did. Look what they did on that break right there. They've been longing this whole dump. Just looking at this, I know that statistically, most people got wrecked on that fake move. They longed in, just like they got wrecked on the ES play, just like they got wrecked on the Euro play. You need to watch this. Listen, trading is a game of probabilities. We need to stack as many probabilities as we can. Here's a stat for you. This is from Thomas Bukowski's studies, one of the largest reference chart pattern studies out there. Breakouts from chart patterns fail to throw back 55 to 70% of the time. Even successful breakouts usually more often than not retest the level first. In the FX and futures backtest, the first breakout attempt fails more than half the time, 40 to 60% depending on the pair. Lower time frames like 5 and 15 minute, even higher failure rates, significantly higher. And in crypto backtests, raw resistance breaks succeed only about 30% of the time. If you add volume and delta confirmation, it improves to about a 55% success rate. So yes, statistically, levels hold more often than they break. Why am I telling you this? What does this mean for trading? Because the base case is levels hold. Don't assume breakout, assume rejection. Fade first test. The first touch of a strong level usually fails. If it's going to break, it often makes multiple stabs at that level. Only trade breakouts with all confirmations. Price, volume, momentum, session time. Without all four, the odds are against you. So maybe instead of asking, will this breakout run? We need to ask ourselves, what's the probability this level holds versus breaks? Now, statistically, we know holding is more likely. So your job is to filter for the rare times when breakouts are real. Volume, delta, acceptance, and timing. So what does this look like in real time? Well, I'm going to walk you through the trade that I took this morning, trading live with the crew in Discord, together, sharing screens like we do every single day. We went into the session, into the New York-London overlap with a range. Boom, boom. That means there's liquidity above and liquidity below. I am looking for one of two scenarios. I'm looking for a break showing real interest, real sustained buying, or a break lower showing the same thing but with selling, or a sweep up grabbing liquidity and shorting it down. A sweep down grabbing liquidity or shorting up. I don't care which way price goes during the day because I can short and I can long. I'm just looking for the price tells. Also, I want you to pay attention to the actual price movements without looking at volume. You're going to see the absorption. You're going to see a whale sitting up here in real time, gobbling up all those longs and shooting price down. Whale, market maker, whatever your preferred nomenclature is. But watch this. Watch. Boom. There it is. It was a lot more noticeable during actual price action, not using TradingView's replay tool. But I'm looking for those orders to change hand. I'm looking for price to be walked up and then it to change hands for those whales to absorb it and price to dump. Now, on top of that, we had divergences across the board. OBV, CVD, MACD. This was an A+ setup. Sweeping a session high, London, going into that breakout with divergences across volume, showing that the sellers are in control. This is not raw volume. This is OBV. We can take a look at CVD too. This is showing what whales are doing. $1 million plus orders. You can do this on crypto. You can't do this, to my knowledge, with Forex, but what you can do with Forex, or any stock for that matter. Let's go back and look at that ES1 play. Look, market opened, and the whole time, sellers were in control. So on this break that we looked at earlier, I know my chart's a little messy here, I apologize, but you can see price breaking up. There was a divergence. It was weak. It was a fake out. Look at that. Here's that fake out. And the whole time, CVD was winding down, right? Cumulative volume delta. It takes the volume and it lets you know who's in control. If it's red and trending down, right? It's cumulative volume and it's the delta. It's the difference between the buys and the sells. So raw volume without context of who's in charge does not equal confirmation. We need to know who's in charge. Is the volume real volume, or is it manipulation to snag orders to grab all those breakout traders and run it the other way? Now, what would the inverse look like? Well, the inverse would look like we took out that high. Boom. Here's the next tip. You can chart, and you should chart your indicators just like you do price. Here's where market opened. That's our baseline for price action. We made a higher high. We made a lower high on CVD. Then we made a higher high, and we made a lower high on CVD. That should be showing you warning signs. So if we are to look for rejection more often than breakout, this is screaming rejection, short, and fade the trap, which it was a trap. Momentum was fading, right? We can see that. We can see that here. Not only that, the time of day is correct. So we have a price Q, the SFP. We have volume confirmation for the short, but we don't have any volume confirmation for the long. We have momentum, volume, price, time. Everything is lined up for an A+ short. Same thing with Bitcoin. There is no confirmation that this is real. If there was, then I'd want to see this CVD line break that high, which is from the range high here. But it wasn't. It was diverging a lot. If price is doing this, I want to see my indicator doing this from high to high, from high to high. If we take out this high, the indicator better take out that high too. If it doesn't, there's your red flag. If your opening range is doing this for price and your indicator is doing this, and we start to break up, but we don't on your indicator, that's a red flag. If we do break up and your indicator breaks up, that could be your green light, but you still want to make sure your time is right, your momentum is right, and your price and your volume are all aligned. That's how you get to those A+ setups that we're looking for and really only want to take. So what does this look like? What's the main takeaway for this video? The confirmation playbook is this: price plus volume plus momentum plus time equals traded. They all align, you take it. Price plus volume divergence is a trap, fade, or stand down. Never trust volume spike without session context. Don't just watch or wonder. Plan, confirm, execute, and make things happen. So volume confirms, but only if you know how to read it in context. CVD alignment, session timing, and momentum are the real confirmations. Everything else is noise. Chart your indicators like you chart price. If price is making a higher high, so should the indicator. Don't fall for the traps. Retail loves breakout chasing. It feels exciting, but pros fade more breakouts than they trade, and the stats are on their side. We will expand on this in future videos. We will break it down and get more into it. Smash that thumbs up, subscribe, turn notifications, and I'll be back for more.